Hi, this is Karen Lin. This video clip serves to illustrate the consolidation process when NCI is present. Let's follow the example in notes. This is note 4.3 and this is page 2 of the note. Lowell Corporation acquires 80% of Boston Corporation on March the 1st, 2014 by exchanging 10,000 shares of $1 par of Lowell's common stock for 80% of the Boston Corporation shares of $1 par. The market price per share for Lowell Corporation was 36 on the date. So from this information, we know that there are $10,000 because 10,000 shares multiplied by $1 par. That's the common stock that Lowell should record for this investment, and the rest $35 multiplied by 10,000, which is $350,000, would go to additional paid-in. In addition, Lowell paid $5,000 cash for combination costs such as legal and accounting that would be expensed right away, and $3,000 cash to a broker for stock issuance cost. So this $3,000 would reduce the $35 multiplied by 10,000, which is additional paid-in for $3,000. And before acquisition, Boston Corporation had 15,000 shares, and the market price per share was $25. This means that for the non-controlling interest who holds 20% of the shares, their shares worth $25. We can see that Lowell Corporation, Boston Corporation's information are the follows, and we see that the equipment was undervalued by $30,000. Other things are the same. The fair value and the book value are the same. We know the equipment had 10 years remaining useful life, and any excess over book are attributed to the goodwill. So we start with the allocation table, and this could be traced back to note 4.2. I want you to go back and read it, but it's basically pretty simple. How do we calculate the fair value of Boston Corporation? Is that we start with the Lowell Corporation's payment, which is $36 per share, 10,000 shares. So basically, Lowell paid $360,000 for Boston. You can imagine this process as Lowell sold 10,000 shares on the market for $360,000, and then using the cash to buy the stocks from Boston's shareholders. And we know that Boston has 15,000 shares outstanding. So NCI has 20% of 15,000. That would be 3,000 shares. So 20%, 15. And then 3,000 shares, each share $25. It would be $75,000 for their fair value of the payment, sort of. So compared to our previous chapters, this is kind of the same as the consideration transfer in our previous chapters, but we now call it total implied fair value. So we add these two things up, we know the Boston Corporation's total fair value of $435,000. And we take the book value of Boston from the total payment, we got the excess payment implied. How do we get the book value of the Boston? We can look at here. We can use Boston's asset minus liabilities, or we could add up the common stock, additional paid-in, and retained earnings March the 1st, 2014. Now, I want you to note that this is retained earnings 1-1, so that you have to add the revenues minus expenses minus dividend to get retained earnings March the 1st. Sometimes if you are in an exam, you can calculate the net asset by using asset minus liabilities, and you can also verify your number by adding the common stock, additional paid, and then retained earnings ending together to see whether you got the right number. That's just a little tip from me. And so take the difference between the two, you get the excess payment, and we need to allocate this excess payment to the equipment and goodwill. So we will allocate the undervalued equipment, 30,000, and the rest goes to the goodwill. I want you to look at the allocation by the CI and NCI. So again, the CI paid 360,000, NCI hold 3,000 shares, each share $25, so 75,000. And when we minus the book value of the Boston, the book value split it by 80%, 20% between CI and NCI. So multiply by 140 by 80%, that's 112. 20%, that's 28,000. And we get the excess payment by the two parties separately. And then for the undervalued equipment, it's also 80% and 20% of this 30,000. So 80%, 24,000, 20% is 6,000. Take the difference between the excess payment and the undervalued equipment by the two parties. We know the goodwill. So now I want you to pay attention. The goodwill here is not proportional to the ownership of the CI and NCI. The reason is CI basically paid more for the control of the subsidiary. We call this control premium. Okay, we call this control premium. Okay. All right. And annual amortization for this case would be the fair value excess of the equipment, $30,000 divided by 10 years, each year $3,000. And we do not really need to split this between the CI and NCI, because when we do the consolidation, it basically take the whole 100% from the specific assets, which is the equipment. So we do not need to split them. Now let's start with the consolidation. Okay, I want to start with the consolidation by using the consolidation process with the predicted numbers of the consolidation. So this is basically the intuition of the consolidation. I want to predict first and then show you how the mechanical ways, which is the worksheet with the adjusting entries, that can reach the consolidation numbers. So let's start with the prediction. The consolidated revenues should be the parents plus the sub. So it should be the parents plus the subs number. And the expenses are the same. However, remember, we need to add back the annual amortization that should be made by the subsidiary, but the subsidiary recording the equipment on the book by its book value, so the depreciation taken is smaller than it should be if it's a fair value. So we need to add this 3,000 back to the expenses. Okay, and equity in subsidiaries earnings will be 0 because this is inter-entity. And net income would be, the consolidated net income would be derived from the above, so revenue minus expenses. Now we need to predict the NCI in the subsidiary, so net income attributed to NCI. How do I predict this number? I hope you remember that we talked about the two sets of accounts that mirrors each other. The NCI in subsidiaries net income mirrors the equity in subsidiaries earnings, which is the subs net income multiplied by the percentage of the NCI minus the amortization multiplied by the percentage of the NCI. So this is basically the same as our investment account of the parent. So we do this. So it's basically the net income of the subsidiary, right? So the net income of the subsidiary, this is a negative number, so I add the minus sign before, just make it positive. And then minus the amortization 3,000. Okay, and this would be 100% of the subsidiary's economic income multiplied by 0.2. Okay, so that's 74,000. So we predict this to be 74. Okay, and the net income attributed to the parent would be the consolidated net income minus the net income attributed to NCI. So basically, we add up the revenues, expenses of the parents and subsidiary together, but we remember there is a part of the subsidiary's net income that's shared by someone else than the parent. The someone else is the NCI. So the NCI has some share to the net income. So we need to take this share out of the consolidated net income, which becomes a net income attributed to Lowell. Lowell is the parent, and it's the CI. If you compare this number with Lowell's own net income, they are the same, right? This is because the equity in subsidiaries income includes basically the net income of the subsidiary minus the amortization multiplied by 80%. So I can verify this for you. This minus 30,000, 3,000 multiplied by 0.8. That's exactly this number, right? So basically, when we take this out from the net income, the rest becomes the parent's net income. Just want you to be sure, if you don't get these two numbers the same, there must be something wrong in your consolidation. Retained earnings 1/1 equals to the parents, because the parents shareholder has the claim to the retained earnings of the subsidiary, plus the net income. The net income, I want to point out, this net income number has to be the net income to the parents or to the CI. The reason is that the statement of retained earnings is the claim of the reserve of the company by CI's shareholders, by Lowell's shareholders. So it's the net income of the parents we are adding to the statement of retained earnings. The dividend should be the parents, because the subsidiary's dividend is paid internal to the entity. And retained earnings December 31st, 2015 should be the add up of the above. Okay. Now, consolidated cash. Consolidated cash is just the add up of the cash of the two companies. Receivables, the same. Investment should be 0. Land should be the same. Buildings should be the same. Equipment. Equipment, we have the fair value excess of 30,000 when we acquire the subsidiary. Now at 2015 December the 31st, we should use the P plus the S plus the unamortized fair value excess. How do we calculate that? That would be the 30,000 original fair value excess. The 30,000 original fair value excess, every year 3,000 is taken. Now remember, this company was taken over on March the 1st, so for 2014 it's only 3,000 multiplied by 10 months out of 12 months. That's 2014. For 2015 it's the whole 3,000, because that's 12 months. So this is basically the unamortized fair value excess at at 2015 December 31st. So we know equipment would be this plus this, and then plus the unamortized fair value excess at the end of the year. Okay, goodwill would be from the allocation table, the goodwill of the whole group would be 265,000. We do not compare, we do not divide by CI and NCI because this is the financial status of the whole group. Remember, we are consolidating 100% of the subsidiaries' assets and liabilities to the consolidated financial statements. Next, accounts payable, the same. Add the P and S up. Bonds payable, add them up. Common stock, we only have the parents. Additional paid in only the parents because the parents shareholder is the shareholder of the whole company. Retained earnings is from the above. Okay, so now when I examine my total assets and my total liabilities, stockholders' equity plus together, they are not the same. Now I freaked out because they are not the same. But if I look at my financial statements closely, I notice that I have a non-controlling interest under the equity section that I have not filled in. So we need to predict the ending balance of the NCI at December 31st, 2015. How am I going to do that? Basically, how I'm going to predict the number is on the note. So if I look at the note, this is page 7, I show that the NCI basically mirrors the CI's investment account. So it starts with the cost, adding the net income minus dividend minus amortization multiplied by 20%. Okay, and or after a few years it becomes NCI 11 plus subs net income minus subs dividend amortization of that particular year. This is 2015, of course. So I show you how I derive the NCI 11 and then convert to find out the NCI December 31st. But an easier way is just to utilize the fact that the NCI mirrors the investment account. I can use the investment starting from the beginning of the transaction acquisition, 360,000, and at the end of the year it becomes 389,200. So I take the difference between the two. This is the change over all the past years of the investment account, which would be all these years changes here. And now I want to convert that divided by 80% multiplied by 20% and find out the change of the NCI from the acquisition date to the December 31st, 2015. So if I do that, I find out that the NCI's change would be $77,300. In the beginning, when the NCI acquires the sub, it's $25 per share, and it's 3,000 shares we saw from before. So NCI's cost $75,000 plus the changes that NCI has. That's page 7. Plus the changes. That's the 7,300. We get 82,300. So I'm going to calculate it here. That's the NCI. It equals to the original cost plus the change. Basically, a change of the investment account was this number, the investment account, minus originally investment account was 360,000. This is the change of the CI's investment account divided by 80%. That's the 100%, and then multiply by 20%. So this is basically telling us how much the NCI has been changed because it mirrors the CI's investment account, and plus the cost of the NCI. We know the ending balance of the non-controlling interest should be 82,300. If I add that back to my liability plus stockholders' equity, I can see they are now the same. So if you see that your stockholders' equity plus liability is not the same as the total assets, you should review the structure of your financial statement and see whether you left out the non-controlling interest. From my past experience, my students mostly left out the NCI because they forget there is some other people that holding a small portion of the subsidiary. Now let's do the worksheet. So again, the worksheet is the debit and credits, and the consolidated balances should be the debit plus the credit, the P plus S plus debit minus credit. So I already put in the formula in the sheet. So this consolidated balance now, without adjustment, it's just a simply adding up of these two columns. Sometimes they are not the same as our prediction. That's when we need to adjust. Let's start with the SAIDE, and we have an N entry just to take care of the NCI in subsidiaries earnings. I'm going to start with the S entry. The S entry start with the investment, the retained earnings 1-1. Okay, so would be the retained earnings 1-1, common stock, additional paid in, right? So that's my S entry, and I debit all these adding up. I add up the whole to show they are the same. And the S entry of the investment, we need to credit investment for, remember now we don't credit 100%, we credit 80% of all the S adding up. This S entry is the 80% of these 3 guys. Add it up, multiply by 80%. Okay, and the rest 20% goes to the NCI, so it's the S entry, but with these 3 added up. By 20%. So 80% goes to the investment, 20% goes to NCI. We move to A entry. A entry allocate the assets, in specific assets to the subsidiary. So we start with the equipment. Now remember, the A entry for the equipment should be the unamortized fair value excess up to 1-1, because we need an E entry to take care of this year's amortization. So at 1/1/15, the unamortized fair value excess should be the 30,000 minus 3,000 every year. But for 2014, so 1/1/2015 should be the original fair value excess March the 1st, 2014, up to December the 31st, 2014. That's 10 months out of 12 months. Okay, so sorry. So the unamortized fair value excess up to 1/1 should be 275,000. So if you see, the difference between the two is exactly the 3,000, which should be taken care by the E entry. So 275,000, and the goodwill would be 265, as we already seen. That's the A entry. So the A entry eliminates the fair value excess in the investment account. We basically add them up, multiply by 80%. That's for the parent, and the 20% goes to the subsidiary. Goes to the NCI. Okay, that's the A entry. So basically, S and A are as what we done before, but just get splitting between the CI and NCI. Now, D entry eliminates the dividend. Dividend has a debit balance, so we take a credit of 16,000. This is also splitting between CI and NCI, so CI got NCI got this number, 20%. That's the D. Now, I put the I next to D because I want to illustrate the I and N. The I entry is the same as before. It's basically the equity in subsidiaries income. So that's the I entry, takes the whole equity in subs income, and we debit the same. Okay, but we also have a similar, remember the NCI in subs earnings, the NCI in subs earnings or net income attributed to the NCI mirrors the equity in subs income. So we use a new adjusting entry called N. So N is basically what we have calculated before, the NCI in subs income that equals to $7,400 as we predicted. So when you do the consolidation, if you do not predict, you have at least know how to calculate NCI in subs earnings. So this is basically this number. Okay, now the consolidated balance should be this plus this plus this minus this. So we see if I do not do this, it would be 0, but if I have to put it in to make the consolidated balance equal to the predicted balance. And also I would credit CI, debit the I, credit investment I, the same, I debit the net income attributed to NCI, credit NCI. So I'm just going to copy and paste. Okay, this is the NCI, so I'm going to paste. Okay. Now, if I look at my investment account and my NCI account, I see that my investment account does not go to 0 as predicted, and my NCI account does not go to the NCI as we predicted. So I realized I may have made a mistake. I went back and checked my answers. I realized that I did make a mistake because when I split the A entry, I add them up, right? And split them 80% and 20% between the CI and the NCI. That's where my mistake come from, because remember, the CI and NCI, they are not paying the subsidiary on the scale of 80 and 20. Rather, the equipment excess are split between the two by 80 and 20, but the goodwill is not. So we need, basically when we do the A entry, we cannot split the equipment plus goodwill by 80 and 20 because the goodwill is not split according to the proportion. So I go back to revise my answer. I want to make sure my A entry is correct. So my A for my CI A for CI equals to the equipment multiplied by 80%, okay, plus the goodwill allocated in this allocation table, that's 224. Okay, I'm copy and pasting. So adding the 224,000 to that's the goodwill for CI and the equipment 80%. And for NCI, this number equals to the equipment multiplied by 20% plus NCI's goodwill. Okay, so I'm going to add the goodwill here. That's the 41. Okay, I can see now this number and this number is not the same as what I did, so I revise my answer to this and to this. Okay, now it seems that my answers are correct because I revised my A entry. Now I just want to check these numbers between the two columns to make sure my mechanical are the same as my predicted numbers. Okay. Now I look at the numbers, I realize my equipment is not the same, so I realize that I forget to put my E entries in, so I need to add my E entries by the 3,000 and then credit the equipment by 3,000. Okay, if I look at my equipment now, they are the same, so I quickly look at all my answers, and now they are the same. The reason was that if I didn't put in the E entry, that would change my expenses and net income, and that would change my retained earnings December the 31st. It would also change my stockholders' equity. Alright, so I hope from this video you learn how to do the consolidation by using the worksheet when NCI is present.